Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by foundersuite.com. Today I have Ben Johnson of Spruce coming to us from Houston. How's your day going, Ben?
Hi, Nathan. Yeah, my day's going very well today.
Good. What's going on in Houston these days?
Well, we're in the window of gorgeous weather here. So you get a couple months in the fall and a couple months in the spring. Apart from that, it's a little bit of a quiet day in the office. Most of our team has. So an interesting story about Spruce is we started here in Houston, but as we grew, in the early days, it was great to be here. We're very close to some key multifamily operators, which is the industry we operate in. As we grew, it became more and more important to be close to talent. And so this summer, we moved the whole leadership team from Houston to Austin. So I'm still here, but I'm spending about 80% of my time in Austin, and we'll be there fully very soon.
Cool. Well, we'll talk about that a little bit more. Let's start off with defining Spruce. What do you guys do?
Spruce provides lifestyle services for apartment residents. And we're part of this burgeoning sector of real estate, prop tech which is the new hot buzzword these days. But multifamily is one of the largest sectors of the real estate industry. And there's been this interesting trend that's created a whole new sub-market for multifamily. And that is what's focused on the resident experience, right? So for the last 30 years, apartment operators have been very focused on physical assets, which is common areas and weight rooms and pools. And they started to see diminishing returns there. And there's this interesting trend of multifamily operators becoming more focused on creating an experience, right? Thinking about a property as a way to deliver an entire lifestyle to a resident. And Spruce was early on there. We felt like there was a better way to provide home services inside of an apartment building. If you think about it, you have 300 residents all living on top of each other, but the status quo is that there's 15 to 20 different dog walkers servicing that building every day, or the same number of housekeepers, right? And the premise of our business is that, well, if we could just get all the resident demand together and pool the demand, we should be able to broker a better deal for those residents who live there. Because when you really look at what economics are achievable, if you can take a housekeeper and keep them in one building all day long, you can literally double their efficiency or cut their job cost in half, right? So a housekeeper that has to drive between jobs can do 3 jobs in a day, but if you can keep them in one building, that same worker can do 6 jobs. So Spruce does housekeeping, pet care, dry cleaning, wash and fold, and then our most innovative service line is called chores. And chores is something like has never really existed for the average consumer before. You can literally book for $15, we'll come and fold all of your clean clothes, or just wash your dishes. For $12, we'll change your bed sheets. For $20, we'll clean only from your kitchen. It's truly an a la carte way to receive like in-home services, and it's something that's only possible because we service the whole building.
Interesting. So I guess who's paying for it? Is it the building operator, or is it each individual resident opts in to subscribe to this, or what's the model?
So the service is essentially free to the building. And we partner with the building to market to residents in an innovative way. And we're able to get this partnership because the business model we've created is actually delivering like a higher quality of service than what's out there. So for the resident, we price below market, because they share in the efficiency gain, right? They share in part of that 50% cost savings. So they're getting below market prices. They're getting to book through a mobile app, and they have services that are delivered without needing to give a key out, without needing to call the property and let them know we're coming. It's seamless, right? So it's free to the property, and the resident pays below market prices for the services.
Does every resident need to sign up, or if you had 20% of the building wanting to opt into this, does that make the economics work, or you need the whole building to sign up?
So no, the whole building does not need to sign up. Although we're moving into a world where multifamily operators see Spruce, where everyone is background checked and bonded and insured, we're actually providing insurance endorsements to the property. We're moving to a world where the multifamily operator only wants their residents using Spruce. And it's so beneficial to the resident being like a higher quality service at a lower price that it is a strongly preferred suggestion. But we're moving towards a world where the buildings may someday require the residents, every service is going through the Spruce platform.
Okay. So how many, are you just in Houston, or how many cities is this offered in?
Houston was our first market, but Spruce is now in 5 cities. So Houston, Dallas, Austin, Salt Lake City, and Denver.
Okay, gotcha. It's an interesting model. I like my dream after I retire is to live in one of these hotels. Like in New York, you hear about these hotels that have condos in the top 20 floors, and they get full room service, maid service, everything else. It's kind of the same concept in some ways, I guess. What's it cost? Like what if I want all my dishes, my laundry, my everything done, what do I have to pay for this?
Yeah, so traditionally, if you want a full housekeeping service for a 1-bedroom, 1-bath apartment, you're looking, the market prices are somewhere around $90, right? Which is about $45 a man hour. So our price point is going to be about $75 for that full cleaning. But many people don't want that. Like, they don't want a full cleaning all the time. Maybe, like for me, actually, every Monday, I leave 3 loads of clean clothes on the couch. And a Spruce housekeeper comes and folds all 3 loads, leaves them folded better than I could do myself for $15, right? And then Thursdays, I get my full cleaning done, right? Which doesn't include the clothes folding, but you're able to just pick and choose exactly what you want. Let's say you want to cook on Tuesday, so we'll come to the dishes on Wednesday, $15, right? So it's a totally different way to think about how we fit into your lifestyle.
Okay, interesting. Cool. There was one startup I remember. It was the maid service on demand that I think for some reason didn't work out. What was the deal with that? And I guess how do you guys avoid that issue?
So,
who was that?
It's hard to just answer that question without kind of telling the story there, because it's fascinating. You're thinking of HomeJoy, I believe.
Oh yeah.
HomeJoy kind of left a crater, pretty much shut down overnight. And HomeJoy was taking the Uber for X model and applying it to housekeeping, right? And if you look at, so one of my favorite reading sources is Andrew Chen, now partner at Andreessen Horowitz, and he has a framework on the evolution of marketplaces. And we started, marketplaces started being referral marketplaces, more hands-off. Then you moved into the Uber for X model, which works for some industries like transportation, works kind of well for dog walking, like WAG. And for housekeeping, it did not really work at all. And the reason there is that you're talking about a service that is highly specialized, that is subjectively graded, that requires specialized workers, not general skills. Dog walking is a little bit more of a general skill than housekeeping. And it requires a high level of trust and complexity and customization. So for all of those reasons, this Uber for X model didn't work. And now in the world, if you follow Andrew Chen's framework of managed marketplaces, and that's exactly what Spruce is. So we don't partner with independent contractors at all. We have 0 independent contractors on the platform. We partner with local small businesses. And these businesses that we partner with in our various markets, they operate under the Spruce brand. They follow our best practices. They use our vendor for background checks. They meet our insurance requirements. But most importantly, they run their business using the Spruce operating system. So they have a manager dashboard and an employee mobile app, and they are literally using our tech to manage their entire workflow. So as we send them jobs, those show up on their dashboard. They can staff them to their approved employees, and it's a seamless interaction. But lastly, I think another key point there is we centralize the customer support. So when a resident has an issue, and frankly, when you're getting bodies into a certain place, like issues are going to happen, right? This is a people-intensive business with complex services. So it's personal, and you need somebody to reach out to. So you reach out to Spruce, and you get somebody call, text, or email 18 hours a day.
Yeah, interesting. And you mentioned, like, in terms of business model, we'll get a apartment complex on the system, negotiating better rates than each individual resident could get themselves. And I guess you're just taking your margin, or you're taking your cut of that for managing the operating system and everything else. Is that how your business model works?
Yeah, great question. So if you look at this 50% per job cost savings that we target on all of our jobs, like we're driving about 50% efficiency gains. We take that, and about half of it's our margin. A quarter of it goes to the resident in the form of lower prices, and a quarter of it goes to the service provider. So they're ultimately making more. That's a quarter of the cost savings, right? Yeah. So they're ultimately making more than they would. And Spruce, which is supplying the technology, supplying the customer support, being the front line of defense, that's how we make our money.
Yeah, it makes sense. Your example of the housekeeper who can do an entire apartment complex instead of driving between jobs is pretty obvious and intuitive and clear. So that's good. Very good. So let's talk about raising money for this. So you guys started in Houston. What was how'd you get this going in the early days?
That's a great question. I sometimes joke. I can't believe I was so arrogant to start a marketplace. I had no idea what I was getting into. If I knew and I'm going to start a B2B SaaS company, it'll be much easier.
Sure.
That's a joke. But I did not anticipate the capital need to build a 3-sided platform like this.
Yeah.
And, frankly, in my former life, I was an oil and gas banker here in Houston. And I think I knew like 2 or 3 software developers, period. Just because being in a non-target market, you don't really get exposed to that side of our economy. So there's a lot of blind leading the blind in the early days, but we got enough right to get some of the biggest multifamily operators in Texas very interested in what we were doing. So to start at the beginning, we built an MVP. I found a CTO that we linked up with. He was in Austin, and we used our own money to get a product into the market before we raised any outside capital. And
was it a functioning product or more just a demo of what this could be when you were out there taking around, or some shades of gray in between? Sometimes it's
Yeah. So it was a functioning product for the one side of the platform, right? For the resident side of the platform. We hadn't even started doing yet, which would be integral later on, is property side tech and service provider side tech. So we just had our customer facing mobile app that pretty much linked up to a SQL database, and we would just export the database to Excel every day so we could run the jobs, right? So it was very it looked great from the outside, but there was really no substance behind the technology at all. But I started selling, and the only way I knew how, which was using my network. And I, through years of working hard, I happened to know a lot of people in Texas, like that I at least could reach out to. Really, no one in multifamily. So I used my contacts in oil and gas, and I went through my LinkedIn network. I picked out every single person I knew, and for 3 months, I had breakfast, lunch, and dinner every single day of the week with someone in my network, basically saying, "Can you help me meet anyone at these these top companies? Let me demo my product for you," and then asking for introductions. So that worked, and because a lot of my network, through banking, happened to be senior people in oil and gas, they introduced me to senior people in multifamily who really were not the decision makers for the product that I was selling, but ultimately passed me on to the decision maker and said, "If this works out, come back, and I'd love to invest." Right? I think this is a novel concept. So a few months after we launched our product, we had some good success here in the Texas market. And I went back to some of those people who made intros for me early on, and they became our angel investors. Most of them, in Houston, had never invested in a startup before, which was very interesting. So a little bit more of the blind leading the blind. But it was an interesting experience raising in this non-target market.
Yeah. Did you? I like that sort of very strategic way of, like you said, lunch and breakfast with everyone you knew in your LinkedIn network. Did you have a list of like multifamily operators and say, "Hey, do you know anyone on this list?" Or did you have a specific list you were trying to reach and you worked them to get to those folks, or the other way around?
That's a great question. Not only did I have a list of people that I was looking to meet, I actually went through their LinkedIn connections and picked out which of my connections knew those people, targeted them specifically, and if they didn't offer up those invitations in the meeting, I just asked them directly. So it was a little bit creative, but it worked out well.
That's great. So I'm going to drill into a little bit more. When you're getting these meetings with multifamily, condo apartment places, you're giving them the demo. Did you actually bring it up like, hey, I'm also raising money for this? You're trying to sell them on the service, but did you also pitch them on investing, or did it just sort of come up organically?
So in the first several, I was not even thinking about raising money. They are the ones who brought it up.
Okay.
Now, multifamily as an industry tends to be pretty entrepreneurial. And I think that everyone agreed pretty quickly that we caught a trend and we caught it early. And like this was something that was going to be the future in the industry. So despite all of my inexperience building a product, we found something that really resonated. And so they brought it up. They said, "Hey, look, I'll refer you to my operating team, and they're going to make a heads-up decision on whether this product makes sense for us. But if it does, come back to me. And when you're looking for capital."
I won't put words into your pitch or into your mouth, but I can imagine, like, if I was pitching this, you're seeing WeWork, obviously, with a lot of services for their offices, and they're getting into We Live, which I don't even know if that's going to continue, but it was kind of this high service, living facility. Then you're seeing, of course, Airbnb and all the different other startups. And we've had even a couple on the show that are selling like experiences around staying in a rental place. So you can almost see like, look, this is happening in these adjacent markets. It should happen. The higher level of concierge and experience should be happening at the apartment condo level. I can kind of see how that would be an intuitive pitch. I don't know. I'm just thinking it through, but yeah.
It makes sense. And the people doing these services historically have done it with a direct to consumer approach. And when you go direct to consumer, you miss out on the most important factor to our model, and that's density, right? It is getting density and demand. And that's something that really no direct to consumer approach can do. And it's something, it took us a few years to get right. And I might talk about some of the challenges of going from like angel money to like real venture capital. But we figured out over 3 years, how do we turn this partnership with these property managers into a customer acquisition channel? And no one had ever really thought of multifamily as a customer acquisition channel before. But it is a unique opportunity where you can combine digital and physical marketing, right? And like turning leasing agents into salespeople, putting physical signage in the property, in the model unit, right? And then supplementing that with digital marketing through traditional channels like email, push, and other advertising.
Yeah. I want to get into the kind of switching from raising the seed to VC. But before we get there, one more question. You're raising, this angel round or the seed round from, as you mentioned, people who had never invested in startups before. Probably, I'm assuming people who had made money in oil and gas and things like that. So what was the hard part about that? What was the tricky part you had to overcome? Were they not familiar with a term sheet, or they just have different expectations of what their return's going to be, or what? Talk about that.
Yeah, really interesting. So, I mean, it wasn't all that different than raising, I think, from experienced angels, to be honest. I tend to be very transparent with people. It's part of my style. It's part of how I try and be an effective salesperson as well as a fundraiser. But everyone I talked to, I said, look, I'm either going to give you 10x or more on your money or nothing, right? And like, I think there's probably a greater than 50% chance that this turns into nothing, right? We're looking at if you look at the odds that we're up against here, this is a little bit of a flyer, but I think we're onto something big. I think that this is going to exist whether I do it or somebody else does it, and no one's doing it right now. So like, I think just being transparent in that way. Plus, there's factors. Have you been successful in other aspects of your life, right? I think that, pointing to that, and then also I had some references built into the introductions, right? So the people making intros into the industry for me had worked with me in a previous life. So all that together built a level of trust and at least a willingness to, quote, take a flyer, right? As most people called their early investments.
Yeah, for sure. Okay, let's go now to starting to raise a proper VC round. Talk about that and some of the challenges and whatnot there.
Yeah. So going back to the business model, it's a three-sided marketplace, right? And this is where I think geography maybe hurt us a little bit. And it's that there's very few marketplaces coming out of Texas. Texas, right? And marketplaces on average take much longer to get off the ground than a SaaS product. You tend to have to build a lot more software because you're building for, in our case, 3 sides of the platform plus an internal side, tons of business logic. And I really did not appreciate how much capital it was going to take to even get us to a point of product market fit. So we had sort of exhausted at one point how much we were going to be able to raise in angel capital, at least from where I stood in Houston, Texas. At 1.5 million raised, we needed to get institutional capital involved, somebody that understood what it was going to take to grow this business into what it could be. And I think that in order to get to that next level, we needed to be able to show certain milestones as a company. And one thing just from our business that was really hurting us was inconsistent results from property to property. And we had some properties that we could point out to and say, look, we can repeat these results. This is going to be a huge business. But I think the problem was we hadn't showed a repeatable, rinse and repeat, get penetration rates at all of our properties. So we were in this squeeze point where we couldn't maintain the staff that we had. We had to go from 10 employees down to 5. The business kept growing month over month at incredible rates, but we got squeezed from a capital perspective. So we got very lean. In fact, at one point, we almost had the business to cash flow positive, kept growing. And ultimately, we were able to prove out a method that with capital, we could drive consistent penetration rates at our building level. And at that point, we started to get real interest from the venture capitalists here in Texas. So in Texas, there's 5 or 6, I would call it tier 1 VCs. And we're meeting with all of them, keeping in touch, giving them updates every few months. And finally, I think we got to the point where a few of them were ready to put down a term sheet.
Yeah, that's interesting. So I want to ask a question. Like when you had to shrink, the business is growing, but you're running into a cash crunch, or you could see a cash crunch coming, and you got to shrink from 10 to 5. Where did you trim? This is a tough thing that we don't talk about much, right? In startup land. Like, how do you stay alive? Where do you make those cuts?
I will just say that during that period, it was the dark days, right? I was genuinely unsure if we were going to make it through, just because the morale beating you take when you have to downsize it's frankly, it's terrible, right? And the people who stayed had to shoulder a huge burden. But I think we all believed in what we were doing, and it was hard to deny the fact that we were still seeing pretty incredible month-over-month growth. So where do you trim? I think that's a great question. I'll be incredibly transparent here. There was a lot of discussion about whether we keep investing in the technology or whether we go with what we have. And we were actually about halfway through an 8-month rebuild of the tech stack when we had to make this decision. And so the question was, do we pull the plug on this rebuild of the tech stack, or do we keep doing that and trim elsewhere, like on the operating side of the business, and just everyone has to shoulder a little bit more? We, after much deliberation, decided to keep rebuilding the tech stack, which I think was the right decision, because ultimately I don't think we would have been able to raise that venture funding without having an engineering team. And that's what we would have had to do if we cut there. We would have let go of the engineering team, and ultimately that team is what was a key tenet to getting the venture in.
Yeah, no, that's, thanks for being open. It is a tough one, right? Do you cut marketing or engineering? Because like you just said, if you cut marketing, the risk is your growth might slow down and then you're not fundable. If you cut engineering, then you don't have a tech team and you might not be fundable. So it's a really challenging balancing act for founders. So yeah.
I would say it's bespoke, right? I think there's no playbook there. You just have to look at us, and we did cut marketing and we did slow down because of it. However, when we relaunched the tech stack, we made some pretty big advances on the product side. And so we were able to make up for that marketing loss with product improvements, and like really great product improvements at that end. So it helped us get past that.
Yeah. So, going back to this VC round for a minute. So the first couple of meetings with VCs were you just getting skewered because of this inconsistency in the business model, or and then with enough time, did you come back at it? Did you take a pause and come back at it after kind of normalizing your your model or what?
Yeah. So I'll compare and contrast here. Sort of before we made the downsize, it was me and our COO. We were doing the pitches, and I think the first couple we walked out of, and he was former Boston Consulting Group. He said, "Man, that felt like a bad partner meeting."
Mm-hmm.
Shaking our heads and pretty downtrodden about how the first few went. But we took a break. We worked on what we needed to, and then when I went back out to market, this is now May 2018. It was a completely different experience. For the first time, I walked out of a pitch and I was like, so that's what a good one is supposed to feel like. Because when you have somebody, maybe they don't end up doing the deal, but they're like, yeah, I put a term sheet down on this. They're saying it in the first meeting. You're on the right track. It's not just banging your head against the wall anymore, that you're actually talking about structure in that first pitch meeting. They're talking about like what the pre-money would be. When you're getting into that conversation in the first pitch meeting, I think you're onto something.
Without getting too deep in the weeds, what do you think had changed though between those early VC meetings and the later ones? Was it just that you had crisply refined your business model more, or other things too?
I think from the business standpoint, not a whole lot had changed from like a fundamentals perspective, but I knew what questions kind of blew us up in the first meeting.
Mm-hmm.
I put together was a very expensive experiment to run, but I put together an experiment that said, if we had this level of capital, what level of data, what we could do to manufacture higher penetration rates from building to building. And for us, it was about partnering with the multifamily operators to get access to resident data. And so we could automate the marketing to the residents. We were having a big awareness problem in our buildings. And so with capital, I can go get access to this data seamlessly. So that's why you should fund.
Yeah, no, that's good. Because that's also a hard part. Like if you have maybe a suboptimal first couple pitch meetings, it's hard to come back to VCs. So you almost need a new little piece of the puzzle or a new little thing to hang out that's different, right? So it sounds like you kind of identified some of that, right?
Yes, and frankly, a venture capitalist doesn't hold a bad pitch against you, right? If you were thoughtful about it and you just hadn't figured out the equation yet, they'll sort of pat you on the back and say, now go work on this and come back to me when you have some progress, right? And if you actually come back and you answered the questions that they told you to go figure out, doesn't matter how bad your first meeting went, they like that.
Awesome. So just a couple more questions. I'll let you go. Who led the round? Was it seed or Series A that you raised?
Yeah, so Mercury Fund did a Series Seed round for us in 2018, and then by the summer of 2019 we were sort of in between deciding to do like a full Series A at that point. We made a ton of progress, but we'd hit an inflection point in the business and we're growing very quickly. So we decided to just do a seed extension in July 2019, which a new venture fund came in, Fitz partners, and led that. Mercury Fund also participated. So, and then in 2020, we're anticipating doing a full-blown, larger Series A.
Great. I think I saw Capital Factory was on the round.
Yes. So Capital Factory out of Austin has been really great to have as an investor and a partner. They invested in both of our seed rounds, and their network and sort of being the center of the Austin ecosystem has been a great resource for us.
What tips would you have for people approaching them or pitching them yeah?
Well, Capital Factory has a very interesting model about how they invest. They typically like to see you have a strong lead investor, and then if you have that, they'll pretty much invest. Sometimes it's smaller amounts, sometimes it's larger amounts, but they like to follow on a strong lead. So they're not going to step out and lead around for you, but they're great follow-on capital just sort of across the Texas ecosystem. And I think investors like that are incredibly important to developing an ecosystem here in Texas. They're going to be fantastic follow-on capital. They're going to open up their Rolodex. They're going to set meetings for you with your next round investors. So that's the role they play.
Yeah, good. And I think I saw Houston Angel Network. I think that must have been your earlier days, or was that your seed round?
It's interesting. We actually raised a little bit from some of the Houston Angels early on in the company. the Houston Angel Network Angels early on. And then as we had some follow-on space in our later rounds that were led by venture capital investors, they were there to write checks as well. So,
okay, good. Great. All right. Last question. Tell me a little bit about Austin. You guys are relocating to Austin. Is that just because it's a more friendly startup scene, or other advantages?
So I think I mentioned this once, but as we've gotten bigger, and in July of 2019, we were 11 employees, and today, November 2019, we're 25. So as we've hit this stage of our business and we have professional salespeople now, it's less important for us as a company to be close to our early customers, and it's much more important for us to be close to talent. And Austin, from top to bottom, A, has more talent to draw from in the market, and B, has such a positive perception across the whole country that you can almost move anyone to Austin.
Yeah.
And really that was the reason for the move. I mean, Houston is the 4th largest city in the country and has a robust economy, but no large tech companies to draw from. And frankly, it's much harder to move people to Houston. There's a willingness to come to Austin that you don't quite see in Houston. And so, some of it's perception, some of it's reality, but that was behind the move for us.
That makes sense. I went to grad school at UT, and I love Austin. I would move there. I would almost move there if it wasn't for the summers. I think I would move there.
So I love both cities, but I went to undergrad at UT, so very much a Longhorn. Have my season football tickets. So moving back to Austin is not too much of a stretch.
Yeah, we just booked our tickets. Team Founder Suite will be out there for South by Southwest. So
excellent.
Super fun. Let me know if there's any cool parties to hit. It's so much fun to go back there. So very good. Well, anything we haven't covered, or if people want to learn more, I guess you can't, if you're just a resident in an apartment complex, you couldn't go sign up for this today, right? You sort of have to be top down from the building manager, right?
That's right. So we partner with the building manager to create Spruce powered buildings. And today the service is not available outside of our partnered buildings.
But if people want to learn more, it's getspruce.com?
Getspruce.com.
Awesome. Do you plan to come to California, or going to stay on the West for now?
Yeah, so we have 5 markets today, but we're going to be launching 2 markets a quarter.
Okay, cool.
I think over the next 2 years, we're going to roll out the top 25 cities in the U.S. So we're looking for those NFL markets, several dozen California.
Great. Well, we'll be on the lookout. All right, Ben, this is super fun. Lots of good, interesting stories. I'll let you get back to building your 3-sided marketplace and rolling out to NFL cities. That's a lot of work to do, so
yeah,
we'll keep you. But best of luck to you.
Thanks, Nathan. This was great.
Okay.